Good afternoon, good evening. You can see it's dark behind me. I'm in Europe, Central European time at 7:45. On the East Coast, it's 1:45. 1 p.m. NFL games are on, and I am making a market video. My commitment to these videos is that strong. I am foregoing a good chunk of the 1 p.m. games to be able to get this out to you on a Sunday afternoon. You can see a lot of tabs open. Some of them going stale here, so let me refresh them. Let's get to it. There's a lot to get to. I definitely want to talk natural gas. I want to talk gold, silver, precious metals, junior mining. So many topics. Barron's cover. This time really is different for the economy. Just look at the jobs market. Job market's confounding strength. Unemployment remains near historic lows even after the Fed's aggressive rate hikes. I'm not one of these guys that thinks every Barron's cover is a contrarian indicator. I think Barron's gets it right quite often, but sometimes they get it spectacularly wrong. Maybe this is one of those times. We're going to get non-farm payrolls this Friday. Consensus is plus 158K, unemployment rates at 3.8%. I would be willing to bet a good chunk of change that the unemployment rate's going to be over 4% by January. And we're going to continue to see negative revisions to prior months in the payrolls data. So, and that, it ties into precious metals. If we do get a further washout early in the week, that's something to keep in mind because, I don't trade on the non-farm payrolls, but if I, gun to my head, had to bet on it, I would say we're going to have another downside number on Friday with downward revisions to prior months. So that would, generally speaking, be a uplift positive for precious metals. So that's something to just keep in mind. We'll talk about precious metals later, but I'm fading this Barron's cover. Okay. Let's talk stocks. Start with the major indices, and then we'll work our way down the food chain. So far, it's a standard correction in the S&P 500. Those of you who have been tuning into these weekly videos for at least a few weeks know I've been bearish since the beginning of September. That's been spot on. September was a pretty awful month for stocks. I won't say I'm turning bullish now, but I'm turning more neutral. Okay, as we enter Q4, a new quarter, the potential is there for some upside. Seasonality, I'm not going to go into all the different seasonality, but there are positive seasonal tendencies at work here as we enter Q4. Both the presidential election cycle, October is bullish, third year of a presidential term. And then just based upon how August and September went, if you go through different back tests, and this is now 4 consecutive losing weeks for the S&P, back test that, back test this, back test everything. Upside, we're odds favor a positive October here. So doesn't mean it has to happen. Nothing's guaranteed, but the conditions are there for the market to bounce this month. And by the way, it is Sunday, October 1st, 2023. So new month, new quarter. You can see the AAII sentiment survey. You can see we were at 42% bulls at the beginning of September. We're down to 27%. We were at 29% bears. Now we're at almost 41% bears. So big uptick in bears, big downtick in bulls. You can look at various sentiment surveys. They're all starting to show sentiment turning pretty bearish there in the equity market. This chart, the 10-year U.S. Treasury yield, this is probably the most important one. If you had to choose one, you would choose to focus on Treasury yields and what the yield curve is doing. You know, 2 Wednesdays ago, we had the Fed announcement, we had the Powell press conference, and that was right around here, this big move up since then in Treasury yields. We've seen the yield curve have sort of a bearish steepening in the last week and a half. 10-year yield peaked last week at 4.69%. Prior to the FOMC meeting, the last one, it was in the low 4.3s. So we're talking about a 35 basis point uptick in the 10-year, and that's a big move. That's a really, really big move. And we've also seen a pretty strong bid in the dollar up until last Wednesday. This is the euro US dollar cross. Basically, it's the inverse of the US dollar index. And that's a monumental move we've had down since the peak in July. So from 112.50 in the euro USD down to 105 in basically a straight line over 2 months. And a lot of that has to do with the fact that the market continues to price in the Fed keeping rates higher for longer. And that was the big takeaway from that last Fed announcement, the dot plots, the Powell presser. The big takeaway, if you had to just condense it down to one sentence, rates will stay higher for longer. We could delve into that. I've talked about that in the last couple of videos. I'm not going to spend a lot of time on it, but basically the market is not pricing in a cut until the middle of next year at the earliest, and there is still the possibility of another hike this year out there. It's not probable, but it's like a 1 in 3 possibility according to current market pricing. But the big takeaway is the Fed's not cutting. The Fed's not cutting anytime soon. It's more likely they just hold here, continue with the balance sheet run off the QT. Yeah. So here we are. If we look at the SPY, the QQQ, the IWM, Friday's action wasn't great. Big gap higher, sold off late in the session. I know we got a budget resolution or Band-Aid that's going to keep the federal government open till mid-November. And then almost guaranteed as we enter the holidays, they'll come to a deal. There's not going to be a government shutdown during the holidays. So that would, tendency is for the market to rally on Monday. But frankly, I don't think the market was too worried about this whole government shutdown thing anyway. I think more likely than not, we see the market sort of work on a bottoming process this week. And if I just pull up the E-mini S&Ps, the daily chart, I'll just tell you some levels I'm looking at. The downside would be this 200-day moving average. It also kind of correlates to this upside breakout from the megaphone pattern from earlier this year that formed during April and May. We had this upside breakout in early June. Basically, it was about 42.30 was the breakout level. And that lines up almost perfectly with the 200-day moving average now. So, that's 100 points under where we closed on Friday. I would say that's the big downside, reference point, big support. Obviously, last week's low matters, around 42.80 on the E-mini. And you can see I have this purple line drawn here, currently 43.6850. Let's call it 43.70. So that's sort of where Friday morning's rally fizzled out, was right at 43.70. I would say the way I'm approaching this market is it is guilty until proven innocent if it stays under 43.70. if they can get the E-minis back above 43.70 this week and hold it there on a daily closing basis, I would say high probability the bottom's in then. The correction is over. Again, right now we're at about 8-9% correction on the major indices. That's standard stuff. Actually very healthy, bigger picture. And it would make sense that we could put in a bottom here over the next week or two with seasonal tailwind starting to kick in, and maybe the Fed staying on hold as the labor market continues to soften a bit and inflation remains relatively muted. Core PCE data last week, all the inflation data that we're seeing come out in the last several weeks is indicating that inflation is not the big elephant in the room. It's not the major worry. In fact, we're at about 2.5% inflation the last few months on an annualized rate, right? So 2.5% is very close to the Fed's target. I don't think the Fed needs to freak out here and tighten again, but it's possible they will in November. I want to talk about this from Goldman Sachs. In the context of financing the capital replacement needed to fight climate change, so for the Fed to stick to the 2% inflation target would be the equivalent of maintaining the gold standard in the 1930s. So those of you who know the Great Depression, what happened, the Fed held to the gold standard and tightened the money supply, tightened monetary policy during a depression that helped to generate a depression in the 1930s. So the capital replacement needed to fight climate change. What is that? That's the green transition. That is the EV revolution, manufacturing all these electric vehicles, all the energy that's required to manufacture those EVs, all the metals that need to be mined to manufacture all those EVs, and the upgrading, the expansion, the refurbishment of the energy grids globally, and all the energy and metals required to do that, right? It's inflationary, right? It's inflationary. The commodities that will be required for the green transition, for net zero, for whatever you want to call it, the amount of commodities that we need for that is gigantic. The gigantic's not even a big enough word. So the higher demand for commodities will push up the prices of the commodities during a time when the cost of capital has just skyrocketed and supply of the commodities remains extremely challenged. We have contradictory policy making occurring in the world today. In Brussels, in Washington, D.C., we have contradictory policy. Fiscal policy in the U.S. is running huge deficits. So you would say it's fiscally stimulative, but monetary policy is restrictive, and real interest rates are in extremely positive territory. So we have a contradiction going on, and this green transition is also contradictory in many ways. So we could talk in circles here. This video could go on for hours, so I'm not going to do that. I'm just going to cut it there. There's a lot of contradictions going on in the world today. The 10-year is driving the bus here. Yields, the yield curve, this bearish steepening that's occurred has been negative for risk assets. It's been negative for stocks. hugely negative for gold since that Fed meeting 2 Wednesdays ago. So you can see this was the Fed day. We got up to almost 1970 at the high of the session. Since then, it's a $100 per ounce drop. So just reviewing mining Twitter, precious metals Twitter, different precious metals commentators, everybody's going off the deep end here with conspiracy theories, and this is market manipulation, and I'm going to be diplomatic here. I don't subscribe to these theories, and I think the market action the last week and a half is actually to be expected. It's normal. I'm not saying I liked it. I'm not saying I predicted it exactly, but it doesn't mean it's not real. Okay. We've seen a 35 basis point jump in the 10-year yield. We had the Fed clearly go higher for longer in the dot plots. Powell was pretty hawkish in his press conference. And he also said, like, soft landing is not his base case, but not cutting rates anytime soon. You know, the first rate cut was supposed to happen this year. If we go back to 2022, a year ago, the market was pricing in cuts in 2023. Fast forward to today, or even, last month, the market was pricing in a cut in March. Now it's pushed out to June, might even be later than that. There might be another hike, right? So it's just, we've seen the expectations for yields for the Fed funds just be ratcheted that much higher for longer. You know, interest rates in the US are in extremely positive territory. Again, I just mentioned that, you know, the last 3 months of inflation data, we're running at about an annualized clip of about 2.5% in the US. This is not high inflation, yet the Fed funds is at 5.5%. The 10-year yield is above 4.5%. So rates are hugely positive. That's not conducive to gold. That's not bullish, for gold. Sentiment was bearish last week. It was bearish 2 weeks ago. It's even more bearish today. And, sentiment can be a contrarian indicator at the extremes, but on the way down, it will get more and more negative until it reaches an oversold, over extreme negative breaking point. It feels like gold is getting very close. You can see in my bullet points, gold and silver, the daily sentiment index, down to eight single digits for gold and silver. And obviously, this chart looks pretty oversold, looks pretty smashed. But let's talk more about that a bit later in this video. So we talked yields. We talked about this gold chart. I have another one later. We talked about the E-mini S&Ps. Talked about the 200-day moving average. Okay, QQQ. It's very similar. There's this gap fill around 365. Probably a very good chance that that gap gets filled in at some point this week. But then what does it do? That's what you want to look for. Good chance that we get some upside, but does that then turn into resistance, and do we head back down, right? That's the key question I think that stocks need to answer next week. Small caps look absolutely terrible still. This is a very pronounced downtrend under downsloping 50-day moving average, under the 200-day moving average, RSI in bearish territory. So, stocks are not out of the woods by any means, but, when I say I'm turning more neutral, I think they could begin a bottoming process here in the next week or two. I just pull up Pfizer because Pfizer had an up week last week. This is extremely oversold on the weekly chart. You can see what it's done in 2023, down big, what it's done since the end of 2021 when it sort of reached its pandemic highs. From a valuation standpoint, I'm not talking about politics or opinions of vaccines. I'm just talking about the stock market, fundamental technical analysis. I'm not going to get into the vaccine stuff. This is something, as an investor, as a technical analyst, this is a chart that I would begin to pay attention to with a more positive bias towards it, that this might be something to look to buy at some point in the next few weeks. Okay, it could be setting up, forming a bottom here, 10 times earnings, pays like a 5% dividend. They've got 40 billion in cash. I mean, I could go on. This has gone down to a valuation and a long-term support level that makes it a lot more interesting if you like money. Energy. So uranium is the bullish sector in the entire stock market, the most bullish. Printed a bearish engulfing candlestick on the URA on Friday. I would say that's a yellow flag warning sign. Maybe the sector needs to cool off a little bit. But, a short-term cooling off could be 3 trading sessions. It could be 5 trading sessions, 5 trading sessions. It could be 2 weeks. But then I believe the sector will set up again for another leg higher. I don't think this bull market is close to being done yet. I know sentiment is bullish. Some may even say it's at an extreme. It's a bit frothy. Nothing that 3 or 4 days of cooling off can't fix. The long-term structural supply demand story is not going anywhere, right? We need much higher uranium price. We need time to build the mines. We need new mines to get permitted and financed. It's going to take time, okay? This bull market has a ways to go in uranium. I want to get into energy, more specifically natural gas fundamentals, and then we'll talk about the chart setup. I'm going to give you some stock ideas too. Number one, look at seasonality in natural gas. So this is since 2004. You can see up basically 2 out of 3 times in October. Average monthly gain in October since 2004 of 6.1%. That's pretty good. So bullish tailwinds heading into October for natural gas. Pull up the chart. We have this big rounding bottom that has formed throughout 2023. It has tested $3 once, twice, 3. This is the 4th or 5th test, depending upon how you want to count it. The more so just simple technical analysis, principles, fundamentals, the more times a level is tested, the more likely it is to break. Usually it's not going to break on the 3rd time. 4th time you got a better chance. 5th time you got a much better chance. We're about to have the 5th test here of this $3 breakout level. And you can see, it was just this massive downtrend at the end of 2022 and in January that brought natural gas from $7 down under $3. That was a precipitous decline. There's not a lot of price memory up here. It wouldn't, a breakout above $3, you could see it at $3.50 in a week, maybe even in a few trading sessions. Okay, it can move up 15 to 20% very quickly, in my opinion. Everything about this chart, technical indicators, the relative strength index, the 60 level on the relative strength index, when a chart has formed such a broad-based bottom and it's testing a breakout level for the 5th time in the last 9 months. This is just, from a technician standpoint, this is everything I want to see on a chart pattern breakout. It's all setting up here in natural gas. So let's talk fundamentals. And I've talked about this, I don't know, maybe 6 weeks ago. I think I brought up some of these bullet points. The LNG story is a very big one. Next year, 3 new LNG plants will come online in the US. I wrote them here, and they will add 6 BCF per day to the export capacity of the US, increasing it by almost 50%, 42% to be exact. This is taking place as production is beginning to decline in the US, and the rig count is down 30% year to date and continues to trend lower. I mean, $2.80 natural gas is not really an incentive price that makes it profitable for a lot of this new production, to come online. The U.S. natural gas market is in the process of swinging from being balanced to potentially into a severe deficit by the end of next year. We have inventories falling. We had a somewhat hot summer, and currently the forecast is for a slightly colder than average northern hemisphere. And we'll see. I mean, the weather is obviously variable, and forecasts don't necessarily always work. But it looks like it's going to be colder and possibly even snowier throughout the central, south central, southeast part of the U.S. Could definitely increase the consumption of natural gas throughout this winter. You have liquid natural gas price in Europe way above where natural gas is in the US. And just the fact that you have all this new capacity coming online with these 3 new LNG plants in the US, this is a huge story. Yes, it's still a year away, but the market is forward looking. It's going to be looking 6 to 9 months ahead. The cure for low prices are low prices. The natural gas price has been low throughout all of this year, and that's enough time for the market to rebalance. And it has rebalanced, and it's going to start to move into deficit based upon everything I see and read. So you have near-term bullish technical case, you have bullish seasonality, and then longer term, when you look out 9 to 12 months, you have a very good possibility of the market starting to move into deficit. And that could absolutely create a big upside move in natural gas prices. So one way to play it is just simply natural gas futures, NG. Not for everyone. Definitely riskier. Definitely a little more complicated because you have to roll the futures. The natural gas market is in contango, which means that the later months are at higher price levels than the front months. The November price is, let's say, $3. The price in December is, let's say, $3.30 or $3.40. The price of January is $3.60, right? So it's in contango, and the roll is not necessarily favorable because the outer months are higher priced, right? Another way to play it, so it's just simply, you could play it through big cap energy stocks. So the biggest one would be a Chevron. Chevron is a huge producer of natural gas. And you can see that even as September was a negative month for the stock market, it was a very positive month for Chevron. It was a positive month for the energy sector more broadly. Chevron is a big producer of natural gas, a big explorer of natural gas, and this chart looks bullish to me. It's in a very clear uptrend, golden cross, 50-day above 200-day, and you can see sort of this 170 level is resistance. If it can get clearly above it, you could have more upside to a new 52-week high above 180. So, I mean, this is a less risky way to play it. It diversifies your exposure a little bit. Obviously, they produce a lot of oil too, oil and gas. Enormous company, pays about a 3.5% dividend, huge amount of cash on their balance sheet. You know, this is a bread and butter name in the U.S. energy sector, right? Then you can move down the risk spectrum. Suncor, Canadian producer, also oil and natural gas. And all the same things I said for the Chevron chart, I can say for the Suncor chart. A little bit riskier than Chevron, but still, you know, mega cap company. And then more high risk, Range Resources, RRC. And this is more of a focused natural gas explorer and producer. And the chart is bullish, but I would note that you've got a little trend of lower highs forming here with these bearish black candlesticks clearly apparent there near $34 a share. So maybe, you know, you don't rush to get into this one. You wait for a little bit of a pullback, maybe back to 31, maybe back to 30. But these are just three ideas, stock ideas on how to play upside in natural gas over the next year. So the highest risk, more direct, shorter term way to play it, futures. The less risky, more, you know, indirect way, Chevron, Suncor, Range Resources. Okay. It seemed like last week may have been an inflection point in a lot of different markets. I showed you the 10-year yield. It peaked out at 4.69%, ended the week at 4.57%. It was no accident that oil moved above 94 Thursday morning and closed the week at just above 90, right? So oil looks to have pulled back a little bit there, maybe peaked out there early on Thursday. Yields may have peaked out as well. And we may have seen a bottom in the euro against the dollar. And, you know, we talked about gold and silver sentiment, extremely negative, 8 reading on the DSI. Well, Thursday, the DSI for the euro was a 7, and the DSI for the US dollar was 93. So another major extreme here in the euro USD currency pair. And last week may have been an inflection point there, you know? So if you're looking to make a bullish case for precious metals, well, what if the dollar peaked? What if yields have peaked and are going to cool off a little bit or consolidate? And maybe oil is going to do the same, right? Well, that should be supportive of precious metals at the very least, because higher oil leads to, in theory, higher yields and a more bullish dollar, negative for gold. But so let's dig into a little bit gold technicals, the weekly chart. I had been showing this sort of pennant pattern that had been forming since June in the last couple of videos. Well, wishful thinking was it was going to hold. It was going to hold above the 200-day moving average. It didn't. Last week was a decisive breakdown. Broke the 200-day, broke the pennant, broke 1900 support, broke some minor support at 1880, and ended on the lows, 1866. So what's next? Well, with this sort of a weekly candlestick, this sort of breakdown, you know, you have to respect the price action. You have to respect the chart. It's a breakdown. It's a technical breakdown. It needs time to heal. A lot of damage was done on the charts in various time frames. I'll say, oh, this is I want to show this 2013 scenario in a bit. But first, on this weekly chart, the 50% retracement level of the November 2022 to May 2023 rally is at 1852. So just under last week's close. That's, I would say 1850, 1855 area is my first downside support level for gold. If that gets tested on Monday, that'll be a very key test, and we'll have to see if it holds and we get a bounce off that level. But much bigger support is down around 1820, 1825. Just look to the left on the chart. Support, resistance, and also the 200-week moving average, right? So this is the big support. A lot of people just say, oh, it's 1800. Okay, well, that's a round number. It's simple and easy to remember, but really it's the February lows around 1820, 1825. Okay, that's the real big support level. So 1852, 50% retracement of this entire rally, and then 1820. Okay, so those are the two levels that I'll be looking at this week to the downside. And then obviously, if we get a snapback rally, if we get a nice bounce, well, 1890 to 1900, that's your first resistance zone. Okay, and then, well, if we get back above 1900, we can talk about that later. I'm not holding my breath. That's going to happen this week. Now, last week's breakdown gave me some deja vu, some nightmares back to 2013, and I pulled up the chart just to check it out and see how this structure was formed back then and compare it to what we had last week. So there's some key difference here. There's some key differences. If we go back to 2011, 2013, gold kept finding support around 1550. It was tested many times in 2012, and then it started to be retested in early 2013 with a very shallow bounce in March. And the fact that the bounce was so weak, February, March 2013, was a real warning sign of what was to come. This big, massive breakdown that would take gold under 1200 briefly by the summer, right? So we're talking about from over 1600 to under 1200 there in a 6-month period. 2013 was brutal, absolutely horrific for precious metals and for mining stocks, right? I mean, this was a absolutely nasty breakdown, right? So, I was thinking, well, that 1500 level break, is that sort of like last week's 1900 level break? And no, it's not. And there's a couple of reasons why. Well, first of all, gold has been in a big uptrend since this triple bottom in late 2022, right? And 1900 was not nearly as significant of a support level as 1550 was back here. Okay, it just hasn't been tested that many times in recent months for it to be this magnitude of a breakdown that we saw in April 2013, right? So, there's not a really good analog to this breakdown from 2013 in this chart right now. Doesn't mean it can't happen at a later date, but right now, gold is still above a rising 200-week moving average, right? And you look at this chart, this breakdown, well, it was initially above a rising 200-week moving average, but then it broke down under it, right? So let's see. And that's also why I point out that this area, 1820, is really, really big critical support, okay? If that is broken, then we got some real problems on our hands, okay? So let's see how things play out. Best case, I think, for gold over the next few weeks would be to build a base, maybe to test this support, and then start to build a base in the 1850 to 1900 area. But after last week's breakdown, you can see the relative strength on the weekly, still not under 30. It's at 39 right now. The CCI is negative 218. So it's interesting how the CCI has gone so negative while the relative strength is still not quite under that 30 level that we would consider to be oversold. So sort of some mixed momentum signals in this chart, but just simply put, after a candlestick like last week, after a multi-month pennant, I wouldn't bet against more downside in the next couple of weeks, So that's why I drew this green support zone box. I think that level is going to have to be tested. And then what the market does after that test, that's the big one. So let's get rid of that. Let's talk silver. So silver's a little interesting because silver's still at support. It hasn't broken. Like gold broke 1900. Well, the comparable level in silver is 2250 or 2240, right? So silver's still hanging in there, but doesn't look great at all after Friday's candlestick. It tried to rally 3% early in the session and then closed down more than 1%. Very, very, very ugly. And I look on Twitter and I see like a silver symposium in Las Vegas is completely packed. Yeah, it's yikes. But if 2240 breaks, I don't want to jump ahead and say, $20 is next, but we're probably going under 22. Okay, we're going into the 21s and then we'll see. But technically, if these lows are broken, the June, the August lows are broken, and you have all of this price history, all of this trapped money up in here, you have to expect that $20 is coming at some point by the end of the year. So we'll see. I wouldn't short silver here. I wouldn't short gold here. That's not, what I try to do. But I wouldn't be buying on Monday either. Okay, from a short-term trading standpoint. Okay, I think that there could be some very nice trading opportunities setting up. I hope to bring those and identify them for you, but I don't see them just yet. Gold miners are a little interesting because, we're back at the March lows on the GDX, but you can start to feel this market, this sector, it's going to be odd for me to say this, but it's true. This is the sense I got while watching last week's action. It doesn't really feel like it wants to go a lot lower. Like it feels like these stocks are now so oversold that even if gold does, let's say, drop to 1830 or 1820 next week, they may already be pricing in that's the extent of the downside, and they're already priced for 1700 gold, right? That being said, this is a pretty nasty down move that we've seen, since the Fed announcement 2 weeks ago. We're at the March lows. It hasn't broken the March low in the GDX. Sentiment is extremely negative, but you have to respect the downtrend too, right? Nothing is screaming at me on this chart that you have to buy it, but it's also not screaming at me that it's got a lot lower to go. I think that this area around 2650 in the GDX could absolutely hold. let's pull it out to a weekly time frame. Yeah, I mean, this 2650 to 27 level. I mean, look back here, 2022, 2023. I mean, this is big. Okay, this is a big test. If this level doesn't hold, then, September, October 2022 lows are in play, down around $22 a share. Just going to throw out MindMed. I've talked about MindMed in many weekly videos. This got murdered along with the NASDAQ, small caps in the last couple of weeks. Basically gone from 430 to 313 in a straight line. Extremely oversold now. I just want to remind everybody that Q4 is when they're supposed to have a very important top line readout for their MM120 phase 2B trial for anxiety. That's a major potential catalyst that's coming down the pipe here in the next couple of months. I don't know, the $3 level is major support. We're almost there. So just something to keep on your radar. This could be a tremendous opportunity to get into MindMed. So, the GDX, I don't have any really strong calls on this one. I know a lot of people think that this is a head and shoulders pattern. It's got further to go. It's got to go down to 22. I'm not convinced of that, but I also don't have a strong conviction that this is a buy right here. However, if we look underneath the surface at individual stocks, mid-tier gold producer, IAMGOLD. So a lot of people are asking, like, what's your game plan here? Which stocks, should you buy? Sentiment is so negative. These stocks are so beaten down. We're heading into tax loss season. What should I be looking at, right? So I'll just tell you what I would be looking at and what I am looking at. It's true. We are heading into tax loss season. October and November could potentially be brutal for some individual stocks in the gold mining sector as people just sell and take their their tax losses to offset gains or other taxable income. I'd be looking to move up the quality spectrum. So there's so many good values now that you don't need to get into really high risk stocks. You could actually get into producers, or you could get into companies that are starting to be a producer, or maybe they have a mine that is in the permitting process and it could get built in the next few years, right? So you don't need to necessarily be in the explorer area. That's obviously the highest risk area. You can actually just go up into producers. And the first one that I would have on my list is IAMGOLD, and I would just simply state it. We're at a major support level. This $2 to $2.20 level is big long-term support. And they have very clear catalysts coming over the next year. Namely, their Cote Lake mine will be built by the end of the year, with first gold pour expected for Q1 and production ramp up throughout 2024. So, this isn't just any mine. This is a very big, very profitable mine. And let's just take a look at some of the stats here. Oh, I got to go up. Yeah, so here we go. Where's the Cote Lake stats? Okay, average annual gold production, 365,000 ounces. Average gold production years 1 through 6, almost 500,000 ounces. Now, IAMGOLD's the operator, but they're not 100% owner. Sumitomo is also a partner on this project. Sumitomo has helped to pay for the construction. So I believe IAMGOLD is only a 60% owner, but still, this is very significant when you consider that IM Gold's total gold production for 2023 is around 450,000 ounces. And Cote Lake, their 60% share in 2024 will be more than half of their total production this year, without Cote Lake, right? So this is going to significantly ramp up their production profile. Also, it's expected to help significantly reduce their all-in sustaining cost profile across their asset portfolio. So mine ramp up is usually a positive, and it can bring with it an upward re-rating in a producer, but it's not without risk, because production ramp up can also have, it can hit sort of snafus. You can have, hiccups along the way. It's never exactly according to plan, but this mine in particular, it's open pit, it's near surface, it has a very consistent and continuous ore body grading about 1 gram per ton gold, and it has a relatively low strip ratio. So in the spectrum of risk for an ore body mining a deposit, I would classify this one as lower risk. So IM Gold definitely on my radar. Minera Alamos MAI. So this is, I said about 10 minutes ago that my sense is some gold miners just don't have a whole lot lower to go. They've already priced in a much lower gold price, and maybe they're going to start to bottom out here, even as gold sort of works on trying to find a bottom. This is one of those charts, MAI, big support around 27, 28 cents. You can see buyers have stepped in here repeatedly in the last couple of months and given bid support around this 28-cent level. I would not say there's a confirmed bottom in this chart until we get a weekly close above 32 cents. But this is in a bottoming process, and while tax law season is very real and prominent here in the next couple of months, some of these stocks have already seen a lot of tax law selling, I would say, in the last couple of months. Victoria Gold, just from a valuation standpoint, this company is trading well under the replacement cost of its assets. I think they made a very shrewd acquisition a couple of weeks ago when they bought another fairly large gold asset with proven ounces in the ground. Not proven, but a resource in the ground from what was previously Golden Predator, the Brewery Creek mine in the Yukon. And so it's clear to me that Victoria has a strategy of being a Yukon gold consolidator, that they're going to continue to consolidate assets in the Yukon territory of Canada. You've seen a lot of insider buying here in the last couple of months in VGCX. Obviously the chart is beaten to hell, but also notable. It was up, slightly, but it was up on Thursday and Friday as gold was continuing to head lower. I feel like some of these charts, some of the ones I've just shown you, IAG, MAI, VGCX, they may not have a lot lower to go. Okay, and I may be putting my foot in my mouth saying that, but 550 a share on VGCX, 27 cents a share on MAI, 210 on IAG. I mean, these are big, big support levels. Let's see. Now, a rare gold stock that is actually still very much in an uptrend, Snowline. I pull this one up because, well, there's not a lot of tax loss selling potential here just due to the slope of the chart. And there's some very clear technical levels. 420 very clearly support resistance dating back to last year, 2022. So far, the 420 level is holding. And this is a very clear bull flag forming on the weekly, And this is probably the number one takeover target in the junior gold mining sector right now. And obviously, B2 Gold has started to make some inroads to maybe being the potential future acquirer here. Okay. So just 4 gold stocks that I would say are very prominently at the top of my radar for different reasons. And I think I've elucidated why they're on my radar for each of them. With MAI specifically, they have an asset, Cerro de Oro in Mexico. This will be the next mine that they build, and it's a very significant one potentially, both in terms of size, in terms of grade, in terms of economics, and I'll just leave it at that. A lot of potential there that hopefully will help to unlock shareholder value over the next couple of years. So 2015, 2018, I meant to write, not 88, redux in junior mining. Yeah, I mean, sentiment right now is getting down to 2015 levels. And with tax loss season right in full view right now, we could very well get to like December 2015, like capitulation levels. I'll just be honest, there's too many people trying to call a bottom in everything right now. And I just don't think that means that we're going to see an overall bottom that easily. I think this is going to take some time. It could even take the rest of this year. We have another 3 months left in 2023. So I wouldn't be I'm not so focused on just trying to call a bottom in the GDX or call a bottom in the gold chart. I would much rather focus on individual charts and individual companies and individual stock ideas and focused on finding the best opportunities to buy during this next couple of months, where there could be tremendous bargains available, than just trying to time a bottom. It's fruitless, right? You can't do it. It's too difficult. So we talked about terrible sentiment, just talked about the 2015 thing, trying to call a bottom. There's too many people trying to call a bottom right now. Negative sentiment is extremely negative. We talked natural gas. This is a bullet point I don't even want to talk about. We've talked too much. This video is already too long. So we come to the end. We come to Aston Bay. So there seems to be quite a bit of confusion around Aston Bay, a number of topics about Aston Bay. First of all, I'll start with 2 weekends ago, I made this video. See, it's got 538 views. A bearish finish to the week for U.S. equities and capitulation gold miners. You can zoom ahead to the 3644 mark. You see this timestamp right. And I explained in pretty good detail why I sold. 2 weeks ago, or actually more than 2 weeks ago. And I also publicly, paper trades on CEO.ca publicly exited officially at 17 cents for a 100% gain. I bought at 8.5 publicly, sold at 17 publicly, 100% gain. Explained why, gave, all the reasons, and they turned out to be pretty accurate based upon what happened last week. A lot of, let's put it this way. In the junior mining sector, there's a lot of knives out, just period, because it's been such a bad last few months, last few weeks, especially bad. So there's just a lot of pissed off people, a lot of people in bad moods, a lot of people with short fuses. I get it. I've seen this before. It's nothing new. But I think it's important to be respectful of others and also get your facts straight, especially if you're going to go on the offensive and attack somebody. Get your facts straight, right? So some people attacked me last week because evidently I was long Aston Bay and they didn't bother to watch my video or even look at my CEO.ca post or my paper trade sale or anything. They just going off of third-hand information or not even updating their information. They just wanted to shit on somebody, something, a company, and Aston Bay was a great thing to shit on last week because of what happened to the stock. Gapping lower to start the week and dropping all the way from 17 cents to 5.5 cents at the low, closing at 6 cents on Friday. It's or 6.5 on Friday. It's obviously terrible. Down 80% from its pre-Labor Day Friday peak, right? But we also know the story here. We know the context that this is a company that was a way to bet on a new discovery, the potential for a new discovery at the Storm copper project in Nunavut, or call it the North Pole, the far northern part of Canada, basically the Arctic, an island in the Arctic near the Northwest Passage, right? And I explained in that video 2 weeks ago quite clearly that I believed at the time that American West was starting to move the goalposts. The assays were taking quite a bit longer than the original timeline. That were making excuses. There's always a story. And then Aston Bay was in the process of trying to close the financing and diluting the share structure substantially, right? And so I just said that the reason why I got into it in early August had now changed a bit, and the setup was no longer the setup that I had initially bought into. And now I believe that the upside was less and the downside was still quite considerable. And as it turned out, the downside was even more than I thought there was. I thought maybe it would come back to 10 cents, maybe 8 cents. I didn't think 5.5, but here we are, right? And there's a lot of reasons for that, including the fact they still haven't closed the financing. They had to reprice the financing, et cetera, et cetera. You guys all know the story. I'm not going to go into it. I think I've explained myself very well in that video and in this one so far. But I do want to just finish off with this, okay? And I will say this because I think there's some important observations to make now where we sit today on October 1st. And looking back to this news release from August 2nd that was written by American West Metals, not Aston Bay. Aston Bay is not the operator. They're not the ones doing the drilling at Storm. They're just a 20% fully carried owner of the project until production, if and when that ever happens, right? But looking back at this news that was written by American West Metals, the title, Major Copper Discovery at the Storm Copper Project Canada. Major copper discovery. So as soon as I read that, and anybody reads that at any time, when we pulled up to the CEO.ca channel on August 2nd, everybody was convinced major copper discovery, very hot and bothered here. Thick intervals of copper sulfides. The discovery drill holes show similarities to many of the world's major sediment-hosted copper systems, including the deposits of the Kalahari Copper Belt and Central African Copper Belt. So, Kamoa-Kakula, right? Incredible copper deposit in the Central African Copper Belt. So they're drawing parallels to one of the best new copper base metal deposits in the world. And then they start talking about holes 2301, 2302. And so notice that this one, 45 meters of visual sulfides, blah, blah, dominantly chalcocite, blah, 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 dominantly chalcopyrite. And then 2302, a second and more impressive discovery, 37 meters of visual copper sulfide, dominantly chalcocite, blah, 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 blah. So all of these words are very positive, to say the least, and they are upping the expectations of anybody reading this for how good the results of these holes are going to be. Remember, hole 2301, visual copper sulfides, dominantly chalcocite, 30 meters of it, right? And then the next hole is a second and more impressive one than hole 2301. And again, so they're saying dominantly chalcocite. Remember, chalcocite is basic, it's very high grade copper sulfide, right? If you have, pure chalcocite, you're going to have copper grades out of this world, extraordinary copper grades, like 50 to 80% copper, right? Now, obviously, this is not pure chalcocite. They're saying it's dominantly chalcocite, which to me means it's mostly chalcocite. But no, it's not really mostly chalcocite. And then look at what they say here in this next bullet point. The two diamond drill holes are located 680 meters apart. The continuity of the mineralized horizon and the size of the gravity anomaly suggest the drilling has potentially identified a very large copper deposit. The word potentially and potential is used a lot in junior mining because obviously there's very little certainty. But to say a very large copper deposit based upon two holes seems very promotional to me, And at the time, it didn't really strike me as obviously this is a very exclamatory, extremely effusively positive news release. I mean, the guy that wrote this was really hyped up, okay? And I think some of the wording of this, looking back on it, especially as the results came out, it was over the top. Some of the wording here was too promotional, okay? And I'm being honest, on August 2nd, when I first read this, that wasn't my take. It seemed like they really had a confirmed discovery. It really did. And they even include visuals, but obviously the visuals are selective. They're only showing little segments of the holes. I mean, it's not even a meter. They're showing centimeters, right? And they're only showing, obviously, the stuff that has the most chalcocite. They're not showing, yeah, okay, they show this, and you can see that, you know, a lot of the core doesn't quite look like this core. It's not, obviously not as much chalcocite. But, you know, a lot of this, you know, disclosure was selective in nature, just simply put. And then we get the news release last Tuesday, September 26th. And look at how they report in the headlines, or the, you know, the header. ST2302 has intersected a 24-meter thick interval of copper sulfides at depth with copper values up to 2.7%, indicating the potential of the deeper system to host higher grade, you know, mineralization. So this is classic junior mining news, you know, release writing. Because if you read that, you say, oh, 24 meters of copper. So this is like, you know, 1 or 2% copper over 24 meters. Potential to host high grade. Oh, but then we look down and we actually read way down here the assay table for 2302. 24 meters of not 2%, 0.2%. 0.2%. And that 2.7% they were talking about at the top of the, you know, in the headline, only a half meter of 2.7%. Right? I mean, basically, it's 1.8 meters of 1.3% copper, 0.7% zinc, and 19 grams per ton silver. Very narrow, 1.8 meters. The rest of it is not economic. You've got 1.8 meters that is economic at 356 meters downhole. This is not economic. It's actually not even close to economic. Okay, the hole 2 is not even close. So we go from 37 meters of dominantly chalcocite copper sulfides, a second and more impressive discovery intersection, to, what was it? 1.8 meters of 1.3% copper. That's the drop off from the sizzle to the steak. There wasn't even any steak on the plate. They sold us an Australian Wagyu, finest cut you can buy, $400 steak, and they delivered a ham and cheese sandwich. Okay? This is not even close, guys. All right? So there's a lot of lessons here. There's even lessons for me that, you know, really need to tear apart. What do they mean by dominantly chalcocite? And how the hell could they say they've identified a very large copper deposit after 2 holes? 2 holes is not a deposit. And then they gave a timeline. First assay is expected in the next 4 weeks. They didn't keep to the timeline. It was not 4 weeks. It was what? 8 weeks? And it disappointed, right? So there's a lot to take away from this, but my takeaway is that American West team that wrote that news release on August 2nd has lost a lot of credibility. I even showed this to a couple of geologists, the wording here and the way this was written. And I said, you know, when you read about hole 2302, what would you have expected? And they both said about the same thing. They said, well, I would expect about 30 meters between 1 and 2% copper with, you know, maybe 4 to 6 meters at a significantly higher grade than the rest of the hole. You know, you might have, 5 meters of like 3 or 4%, and then the rest of the 30 meters is in the 1% area. I said, okay, yeah, I mean, that's kind of what I was thinking too. I was thinking like, they might have a few meters of 5% because of this dominantly chalcocite, and then some of the little core picks that they showed. This. Well, this ended up grading very well, but this is extremely narrow, right? So anyway, that's my take on it. So, where does Aston Bay go from here? Well, I don't know. It's a long winter. They need to close a financing. I'm not even sure the status of the financing, how big it's going to be. I know they said 8 cents with 12-cent warrants. We'll see. There's a lot of things that are unclear right now. It is a long winter. I still believe the Storm project has a lot of potential. It's just very short exploration seasons, very expensive drilling over a very wide area. It does seem like the geophysics has been refined and they're getting better at targeting. But the level of disappointment in this whole 2302 is hard to overstate. And that explains last week's price action. And there's no reason to try and make excuses or short sellers or whatever. No. You don't write some of the things they did in this news release and then come out with 0.2% copper grades. Okay. That's it. This video is long enough. Have a great trading week. As usual, if you found value in this, please hit the like button. Please subscribe to my YouTube channel. Twitter at CEO Technician, CEO.ca at Goldfinger. Peace.